Hey, what's up guys? It's Clint Coons here, and in this video, I'm going to show you how to get around real estate transfer taxes for your real estate. All right, let's get started. All right, now I know I've caught your interest there. You're thinking, how do you get around paying a transfer tax when the state states, oh, there you go, that if you transfer real estate, it could be subject to a transfer tax or a reassessment. So what do you do in those situations where you're investing somewhere and you want to get the property, right? Let's say I have this property right here, and I'll just take Pennsylvania for instance. You're in Pennsylvania, and you would like to transfer this real estate into a limited liability company like this for asset protection purposes because you're flipping the property. So you got this LLC set up for your flip. But if you were to deed the property into the limited liability company, what's going to happen? They're going to treat this as a transfer, and they may assess you $4,000 on that transfer. So instead, you keep the property in your own name and you do the flip in your own name. And if anything goes wrong and someone were to come after you, then that equity in that property is completely exposed. Or worse yet, I mean, not worse yet, but you don't want the profits going to you because this happens to be a flip deal. You want the properties going to your business. You don't want them rolling up into you. So when the property sells, you don't want title cutting you a check because you want that income allocated to your LLC that's treated as a C Corp. So how do we get around this issue? Well, the way you get around the issue is looking at the asset itself and determining what are we trying to protect. So in this case, what I'm most interested in is the equity in the property, right? So in this deal, let's say I bought it for $100,000. And I'm going to rehab the property. I'm going to put $50,000 into the deal, and then I'm going to flip it for $200K. So that gives me a spread of $50,000. Now, I don't want this $50,000 being paid to me out of escrow because I'm listed as the owner of the property. I want to make sure that that $50K gets allocated somewhere else. And I want to make sure that if anybody looks at this property, right? So when I'm doing the rehab, if somebody wants to come after me and they want to get a judgment against me, maybe somebody falls and gets hurt on the property, that I've secured the equity up so it's not just hanging there. Because, you know, if you bought the property for $100K and you have a lender, they're going to lien the property for the amount of the debt. So whatever the lender loaned you, that's going to get protected against the property via mortgage or first deed of trust. So what do you need to do then? Well, you need to figure out a way to come in here and make a claim to this equity. Put yourself on there on title in such a way that doesn't trigger the transfer tax, but it also ensures that when you sell, you're going to get that money going to the entity you want it to go to for tax purposes. Now, the way you do that is what we refer to as a memorandum of interest. Okay? So in this scenario, what I would do if I was this investor, I would take this LLC that's going to be running the flip property here, right? Because that's my flipping LLC. I would take it and I would file a memorandum of interest, record it against the property. Now, by recording that memorandum of interest against the property, what you're doing is you're putting title on notice. When they look, they would see the first deed of trust here with Apex Funding. And then they're going to see this LLC has a MOI recorded against it, and it's going to trigger them that they need to inquire as to what it means that as to this entity having an interest in the property. So at that point in time, what you would tell title when you go to sell, you would say, yes, that this LLC is owed $50,000. Or if you had it actually advance the cash as well, you would write that up in the agreement. It's also advancing the rehab money to do the deal. It's owed $100,000. So out of escrow, what occurs, even though you're the owner, you'll get a zeroed out there because you don't take anything, or maybe you leave yourself $100 as the owner, but the rest of the cash rolls up into this company as it comes from title. So the memorandum of interest is a way for you to work around the title transfer issues you have when you have real estate. This really comes down when you're flipping properties, so that when you go to closing, the proceeds will flow to the entity which you want it to go to. And of course, you avoid the transfer taxes. So best strategy I know of to get around that, make sure that that interest is held by the entity. If you have rental real estate, you know, and you want to transfer that. I've told you in the past, if you saw my other video, and this isn't a flip deal, then just take a deed the property to the LLC, but don't record the deed. By doing that, you've effectively transferred that real estate into the LLC. It's the recording that's going to cause the transfer tax. Get that thing going. So if you want to avoid it, just don't record the deed, but run the property as if it is owned by the LLC. So the tenants would have their rental agreement with the LLC, have all the utilities paid out of the LLC. If you use a property manager, the property manager will deal with the limited liability company that owns the property. It's just the deed never got recorded. So you have two strategies here. One, you can check out my other video, how to transfer real estate. I'll put that in the show notes. But this one, memorandum of interest, if you're flipping property, if you want to make sure those profits are held to you, use the memorandum of interest. Take care.